Okay, let's talk about today, March 9th, 2026, because a massive shockwave just ripped through the Asian markets. In this breakdown, we're going to dig into what happened, why the foundations were so shaky to begin with, and what the data is forecasting for the volatile days ahead. First things first, let's just look at the raw numbers. First up, the Kospi, South Korea's main index. It absolutely plummeted today, closing down a staggering 5.96%. I mean, the selling was so fast and furious that it actually triggered the market's circuit breakers. And if you look at the KOSP 200, the big guys, it was even worse, a drop of 6.46%. The large cap stocks really led the charge downwards today. But you want to see something really telling? Look at the futures market. The March 2026 contract plunged 6.81%. That tells you what the pros are thinking. And folks, they're betting this gets worse before it gets better. So what on earth caused this financial earthquake, right? The immediate trigger, well, it's a story as old as the markets themselves. A classic oil shock, sparked by geopolitical tensions in the Middle East that are just boiling over. Yeah, as the conflict between Iran, the US, and Israel got more and more intense, oil prices they exploded. We saw West Texas Intermediate crude blow past $100 a barrel, even touching $120. Brent crude, it climbed over $110. And that sudden energy crisis, that was the spark that lit this whole fire. And if we zoom out and look across the whole region, you can really see the carnage. I mean, we already talked about the KOSP hitting a circuit breaker, but over in Hong Kong, the Hang Seng dropped over 1.3% as inflation fears took hold. Mainland China's Shanghai Composite was also down, mostly because they're so worried about their energy import risks. And here's the kicker, the Korean won got absolutely hammered against the dollar, hitting a low we haven't seen since way back in 2009. But here's the thing, an oil shock, on its own, doesn't explain how fast and how hard this all happened. The truth? The market was already standing on really fragile ground. There were cracks under the surface, and several powerful economic theories, they can really help us understand why this shock turned into a full-blown crash. Okay, so one of the best ways to get our heads around today is using George Soros's theory of reflexivity. The core idea is pretty mind-bending. Markets don't just passively reflect reality, they actively create it. What investors believe isn't just an opinion, their beliefs actually change the fundamentals of the market itself. And this quote from Soros just nails it. The market is an active participant in shaping reality. If enough people believe something is true, their actions can literally make it come true. And today, wow, we saw a textbook example of a nasty negative feedback loop just taking over. And check this out. This is the theory playing out in real time. Foreign investors got spooked. They believed Korea's economy was in trouble, so they sold off a massive 3.6 trillion won worth of stocks. What happened next? That huge sell-off crashed the Korean won. And a weaker won means import prices, especially for that now expensive oil, go through the roof. And just like that, the economy is weaker. See? The perception created the reality. It's a vicious cycle. And there are other theories that paint an even clearer picture. For instance, think about Korea's biggest companies. A lot of them are mature firms, right? They can't just easily absorb these crazy high energy costs. On top of that, years of super low interest rates created this credit bubble that was just waiting for a pin to pop it. And then you have weaker corporate governance rules, which basically gave foreign money a green light to run for the exits at the first sign of trouble. It really does feel like we're watching a script we've seen play out in past oil shocks. Okay, so that's the why of what happened today. But now let's shift gears and look forward. What do the quantitative models, the data, predict is going to happen next? Let's dive into the numbers and see what they're telling us about the rest of March. So, to figure out if today's chaos is going to stick around, quants use a tool called a GARCH model, and what it's telling us is absolutely critical. The model gives us something called a volatility persistence score, and it came back at 0.97. Now, without getting too technical, that is incredibly high. It basically means today's shock has really strong statistical memory. Its impact is very, very likely to hang around. So, no, this was not just a one-day event. So, that brings us to the big question, right? The one on every single investor's mind. Where does the market go from here? For that, we're going to turn to a pretty powerful simulation method. Okay, so after running thousands of simulations, the data points to three main paths forward. On the bright side, there's a small, about a 15% chance of an optimistic outcome. That would probably require ceasefire talks to start. But the most likely path, sitting at a 55% probability, is our basic scenario where the Kospi just stays under pressure. And then there's the one we have to watch out for, a 30% chance of a really pessimistic scenario, where the index falls even more if the conflict gets worse. So when we put it all together and crunch the numbers, our models spit out these specific price targets for the end of the month. The base case forecast puts the Kospi right around 4,920. And, as you can see, other Asian indexes are also expected to see more pain ahead. All right, so given this incredibly volatile and uncertain outlook, what do you do? How do you respond? Let's walk through a disciplined, quant-based framework for how to navigate this kind of market chaos. Look, the first and most important rule in a market like this is dead simple. Survival first, profit second. This is not the time to be a hero. This isn't about some magic formula to get rich quick. It's about disciplined risk management to make sure you live to fight another day. So, a quantitative approach would dictate 3 immediate actions. Step 1, with a volatility this high, you have to cut your equity exposure drastically. We're talking under 20% of your portfolio. Step 2, you hedge that downside. You use things like put options to protect against that 30% chance of things getting really ugly. And step 3, you can utilize inverse positions, like shorting futures, to potentially profit if the market does keep falling. Now, beyond just playing defense, a smart strategy also involves rotation. What does that mean? Well, it means you increase your allocation to sectors that could actually benefit from this mess, like energy stocks. It also means you focus on quality. We're talking companies with low debt and tons of cash flow that can weather this storm. And finally, you have to hedge against your currency getting weaker. That means holding hard assets, hard money like gold and Bitcoin. Our models suggest that should be at least 15% of the portfolio right now. In moments like these, it's so important to remember that market history, it moves in cycles. The great analyst Ken Fisher says this all the time. A crash, no matter how painful it feels right now, is never, ever the end of the story. It's just the beginning of a new cycle. And that really brings us to our final thought for today. All the data, all the models, all the theories we've talked about, they all point to a period of intense fear and uncertainty. The smart, prudent strategy is to be defensive, of course. But that leaves us with a much, much deeper question for every single one of us as investors. In a market that is completely and totally dominated by fear, when do we find the courage to act?